Hey guys, so I tend to get a little bit in the weeds on this channel with complex commercial real estate investing and finance topics, but in this video, what I want to do is take a step back and start with the basics to give you some practical thoughts based on my experience if you're just starting out with commercial real estate investing today. For many people watching this channel, I know the goal is to get into commercial real estate investing and eventually own commercial real estate properties within your own portfolio. And for many people, even current real estate professionals already in the industry, buying commercial real estate on your own can seem pretty daunting, and rightfully so. 7 or 8 figure price tags are common for commercial real estate deals, and there tends to be quite a bit more complexity than what comes with buying something just like a single family home. So in this video, what I wanted to do is break down active versus passive real estate investing. So we'll talk about the pros and the cons of each and why you might prefer one over the other and which path is right for you if you're just starting out on your own real estate investing journey. Hey, this is Justin from Break Into CRE.com, and if you're new here, on this channel we talk about real estate investing careers and real estate investment analysis. So if you're looking to break into the industry or do your first or next real estate deal, make sure to subscribe to the channel and hit the bell so you'll know every time I release a new video. Now there are many ways to go about real estate investing, but in this video we're going to break down the difference between active and passive real estate investing in commercial real estate deals. And by active investing, I'm referring to direct ownership in deals, either buying property with sole ownership as an individual or managing a property on behalf of equity partners. And by passive investing in this video, I'm also referring to direct ownership in deals, but here as a passive, non-controlling limited partner through a real estate partnership and syndication with a third-party sponsor. So I know that many people watching this channel right now are working in the real estate industry and looking to make that first step in actually investing their own money in the space. But not everyone is cut out to be an active real estate investor or wants to be an active real estate investor. And fortunately, not everyone needs to be an active real estate investor to reap the benefits of commercial real estate investing in the first place. So with that all said and out of the way, let's start by breaking down the active approach and what that entails. Now, this is obviously the most hands-on approach, which is a positive for some and a drawback for others. So direct active ownership in commercial real estate requires property management oversight, leasing and construction management, and also involves the time-consuming and often costly process of actually finding a new deal to acquire in the first place. And for many deals with a significant value add or lease-up strategy, asset management can be an extremely large workload, which can be really difficult to manage if you're doing everything yourself and just starting out. Also, since the total dollar amounts of many commercial real estate deals run well into the 7 figures, this also might require raising third-party equity from investors to capitalize the deal, since even a 70% LTV loan on a $1 million deal would require at least $300,000 of equity to fund. And raising capital brings in a whole new level of complexity and responsibility to managing that real estate asset, since investor management can sometimes be as time-consuming as managing the deal itself. But with that all said, active ownership also has some major benefits, one of the biggest being that it gives you maximum control over your investment. As an active owner or general partner, you decide when to sell the property, when to perform any sort of renovations, how much cash to keep on hand, when to hire or fire a property manager, and how much cash to distribute and when to distribute that cash. And with active acquisition and ownership of a property, you can also often find arbitrage opportunities for properties in the $1 to $5 million range that generally aren't available when searching for bigger properties to buy. These smaller properties tend to be owned by mom and pop investors, and the more sophisticated private equity firms tend to go for those bigger properties with higher fee and profit sharing potential, which often results in overlooked opportunities that can be capitalized on by a smaller, savvy investor. Active ownership also minimizes fees to you as the investor, so you may pay a property manager to oversee the day-to-day operations of the property, but you'll skip paying things like an acquisition fee or an asset management fee that you would be paying out if you were a passive real estate investor in a real estate deal. And if you do decide to raise equity capital on your deal, as a bonus, these fees are actually going to you rather than being paid out by you, which can be a huge help in boosting your overall personal returns. And these are all benefits before taking into account waterfall and promote structures, which I go over in a lot more detail in this video that's going to pop up on the top of the screen. But if your deal performs well and exceeds investor expectations, you'll likely be able to participate in some additional cash flow distributions over what you would have earned if you invested in the deal individually as a result of that. So there are a lot of benefits of active ownership in real estate deals, but for many people just starting out, the entire process of investing in a commercial real estate deal can be extremely intimidating. And I totally get it. The first deal that I closed probably took several years off my life, and several more have come close over time. So what do you do if you don't have the desire, the time, or the experience in real estate directly to be an active owner in your own real estate deals? Well, for people who write off commercial real estate because of the complexity or time commitment, fortunately, there are other options out there that get you into the real estate game with direct ownership, but don't require hands-on active management of a property and the inevitable headaches that come with it. And this is where passive real estate investing comes into play. And the passive real estate investing we're referring to in this video is investing directly in an entity owning real estate property in a real estate partnership or syndication managed by another active investor, commonly referred to as a sponsor or general partner on the deal. So if passive investing is something you're considering, what are the main pros of going this route? Well, number one is that this is truly a passive investment. Wiring money, collecting distribution checks, and handing your K-1 forms over to your accountant at tax time are really going to be your biggest to-do items when investing passively in a real estate partnership. So by investing in a partnership, you'll also be able to participate in many of the tax benefits available to real estate investors, which can, in many cases, often mean that cash flow isn't subject to income taxes depending on leverage levels on the deal. And this isn't the case for many other popular passive investing options, like investing in publicly traded REIT stock, with dividends on those investments often taxed at ordinary income levels. And especially for high income earners who want to minimize their tax bill, direct ownership can be an extremely useful benefit to increase income without increasing income taxes as a result. Especially for those high income earners with limited time to search for deals, tour properties, and close transactions, the tax benefits coupled with the lack of time commitment can make this a very preferable option over active real estate investing. Passive real estate investors are also able to leverage the experience of other seasoned investment professionals who have done this before to help prevent making costly mistakes that someone with 15 or 20 years of experience likely wouldn't make. So with essentially no work, no time commitment, and huge tax advantages, there has to be a catch to passive investing, right? Well, there are definitely a few downsides to consider when investing passively in deals, and the first major downside for many would-be investors is that not everyone will qualify to invest in a passive deal. So sponsors or active partners that run and manage deals generally require minimum investments of anywhere around between $25,000 and $100,000 per investor per deal, and for investors only a few years into their careers, this could present a major barrier to entry, especially for people without significantly high incomes. Many sponsors also require investors to be accredited, which essentially means that the investor has either $1 million in net worth, not including their primary residence, or they've had an individual income of at least $200,000 for single tax filers or $300,000 for married couples in each of the 2 most recent years, with a reasonable expectation of reaching that level of income in the current year. But don't let that scare you away. For investors that aren't accredited, there are generally still options, assuming those investors have the knowledge in the space to be able to make that investment. So for investments that are made under Rule 506B of the SEC's Regulation D, real estate sponsors can raise equity from up to 35 non-accredited investors, but those investors must be sophisticated in the eyes of the SEC. And what this means is that the investor needs to have the knowledge and experience necessary to be able to evaluate the upsides and risks of that real estate deal. Now, this is great news if you're a current real estate professional but don't fall into that accredited investor category just yet. As long as you can prove that you understand the business, this is a great workaround to be able to get into deals before you hit that accredited investor net worth requirement or income requirement. And in most cases, sponsors will try to keep their total investor headcount down, since the more investors in a deal, the greater the administrative burden that generally comes along with that. So in my experience, most partnerships don't usually run into any cap issues with that 35 non-accredited investor rule. Now, once you're in with a sponsor by being an accredited or sophisticated investor, one of the largest downsides to investing passively in commercial real estate is the fee load you might be subject to based on the sponsor you're investing with. Now, this can vary a lot from company to company, but usually an acquisition fee, an asset management fee, a construction management fee, and potentially even a disposition or refinancing fee are all relatively standard on real estate partnership deals. And these fees don't even include any sort of promoted interest or waterfall structure upon sale, which can often decrease passive investor annualized returns by anywhere from about 1.5 to 3% or more, depending on that promoted interest structure within that partnership. Now, with that said, even though you might take a hit with fees and promote structures, it's not uncommon for real estate deals to see annualized returns of 20% or more over a 3 to 7 year period, which is extremely difficult to do by investing in any other traditional paper assets like stocks and bonds. So even if the property as a whole generated a 30% annualized return over a 5-year period, and you only earn 27% per year as a passive investor, that's still significantly better than what you would have earned in an index fund or other paper assets during that same time period. Also, by investing in a partnership on a larger deal, you'll also have access to economies of scale not available to you by just investing in a smaller deal on your own. So properties often get easier and less costly to manage as square footage or unit count increases, and in many cases, it's a lot easier and more operationally cost efficient to own a $15 million property than it is to own a $1.5 million property. So now that we've talked about the main differences between active and passive investing, how do you know which method is right for you? Well, in short, if you want control over your assets, you feel confident in your abilities as a real estate investor, and you don't mind managing properties or investor capital, direct ownership will likely be a slightly more profitable way to invest in commercial real estate. The combination of non-existent partnership level fees or even earning fees for your work on a deal and the back-end upside if investor expectations are exceeded make this a great option for people willing to put the work in and willing to take the risks associated with buying properties and raising capital. But on the other hand, if you're okay with taking more of a backseat in your investment, you have large chunks of capital to invest at one time, and have other time commitments or lack the expertise to make active investing a worthwhile strategy for you, passive investing is still an excellent way to participate in the upside of commercial real estate investing, participate in the tax benefits, and ultimately diversify your overall assets in the process. Like we talked about, the trade-off here will likely be slightly lower returns and lack of control, but if you're able to invest with a sponsor that you know and trust, this can be a great strategy. Now, when talking about passive investing, it is important to note that neither of these strategies are completely without work, since you will need to find the sponsor you'll be investing with, and you'll need to analyze each deal as it comes. But if you're looking for a primarily hands-off real estate investment, the passive option is significantly less work. Now, if you do think you fall into the passive investor category and want to make sure you know what to look for in your next passive real estate deal, I have a course that walks through exactly that, called How to Analyze Passive Real Estate Investment Opportunities, which goes through how to choose a sponsor to invest with, how to analyze markets, and things to look out for from a finance perspective to make sure that your investment returns are likely to be as advertised. And if you've decided to go the active investment route and think you might need to tighten up your analysis skill set before buying your first deal, make sure to check out Break Into CRE Academy, which will give you instant access to over a dozen courses specifically focused on real estate investment analysis and access to a full library of pre-built real estate financial models and exercise files as well. Also, I'd love to hear from you. Let me know if you're an active investor, a passive investor, or a mix of the two, and why you've chosen to go with that path that you're on. Now, if you like this video and want to see more content on passive versus active real estate investing, make sure to let me know by hitting the like button, and make sure to subscribe to the channel so you don't miss any new videos as soon as they're released. Thanks so much for watching. I hope this was helpful, and I'll see you in the next video.